So the big tax question is this: how do wealthy people keep their money working for them when selling their business, real estate, or other highly appreciated assets without paying hundreds of thousands to millions of dollars in tax? What if we, as business and real estate owners who have poured blood, sweat, and tears to growing our wealth, and who didn't hire expensive tax attorneys and CPAs to map out an exit strategy, knew their secrets? Instead of recreating the wheel, why can't we just model the way they deferred 30 to 50% in tax, paid off debt, funded their next business dream, and most importantly, leave a financial legacy to give to the causes we believe in most? What if their secrets weren't complicated at all, and you just need a guide who is a few steps ahead of you? That is the question, and this podcast will give you the answers. My name is Brett Swarts, and welcome to Capital Gains Tax Solutions. Welcome to the Build It to Billions podcast, where we guide successful entrepreneurs and investors on their journey from millions to billions. We believe the key to scaling and compounding your wealth and life starts every single day with the mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal is to help you scale and compound your wealth and life so you can give more of all of it away to help MVPs. My name is Brett Swarts. I'll be your host today. Each episode, we're joined by some of the world's top entrepreneurs, millionaires, or billionaires, and they share their secrets, wisdom, and insight with us so we can all compound and make a bigger impact today. I'm excited about our next guest. He's out of Virginia, and he's the founder of Bonaventure. You can find it at bonaventure.com. And they offer practical strategies for institutional precision with real estate, mostly multifamily investing. For over 25 years, they have forged a distinct path in private real estate investing, guided by long-term vision, entrepreneurial agility, and institutional-grade execution. Excellent track record. I'm excited to have Mr. Dwight Dunton on the show. Dwight, how are you doing?
I'm great, Brett. Thanks for having me. I'm excited for our little conversation.
Excellent. And for our listeners getting to know you for the first time, would you give us just a little bit more about your story and your current focus?
Oh, yeah. I started this business 25 years ago to help our family continue building wealth through investing in multifamily real estate. And over that last 25 years, we've built a business to help hundreds of families build wealth to afford their long-term dreams, whatever those are. And we do it through the lens of housing policy is broken in the United States, and as the economy cycles, there's always an opportunity to make money. And we've been doing this for 25 years, and we're the largest investor in our program. And we look at not how much you make, but how much you keep. And we have a real focus on after-tax returns.
Excellent. Fantastic. And again, people learn more about Dwight by going to their website, bonaventure.com. So great track record. It looks like $2.8 billion in assets under management, $590 million plus of capital invested, 9,000 units, average IRR of 24% and such, 36 full cycle events. What's been the most surprising thing in the last 12 to 24 months, given your track record for 25 years in the multifamily space?
Yeah. I'd say the most surprising thing is retail investors get their news from the Wall Street Journal, which is 9 months behind the curve. And so there was an overbuilding in Sunbelt markets that led to negative NOI growth. But there's lots of other markets where there wasn't overbuilding and NOIs have continued to march ahead. And so, people miss the bottom a little bit because they are reading just generic business publications, but it's been a pound the table opportunity in multifamily and senior housing for about 2 years.
Excellent. What markets are you finding that to be the most prevalent?
Yeah. So what we found is the number one predictor of cash flow growth and NOI is lack of supply. And so there's, headlines are about the dynamic job growth of new companies moving from economically regulatory constrained markets to more free markets, but also a ton of capital went there. So if you were in Charlotte, Austin, Nashville, great places to live, lots of job growth, but even more supply growth. But if you move to Norfolk, Virginia, there hasn't been quite as much job growth, but there's been virtually no supply growth. And so our NOIs in those secondary markets that maybe aren't on everyone's radar have been marching ahead, while some of those markets I mentioned earlier, they've gotten clobbered.
Got it. So the key metric here is really supply. And
Yeah.
if you can really just, and job was maybe the growth and, you know, the sexy moves from California to Tennessee to Texas to Florida
Yeah.
and North Carolina. And you're saying, okay, yeah, that was cool when things were red hot, but, or, a decent, and it's still a good indicator, of course, but what you're saying is the key, if we can, performance indicator really we're looking at here is supply, lack of it. And so places like Virginia, any other places that stick out for you like that?
Yeah, I mean, there are lots of markets in the Carolinas where it's been overbuilt, but then some secondary markets around, Raleigh, there are some really good pockets, but there are also some terrible pockets in Raleigh. Even though they have Research Triangle and they have huge job growth, huge income growth, supply growth has overwhelmed that. And so I think those headlines that an investor reads about a company showing up can inadvertently become an investment Medusa. It'll kill you. Versus looking at the supply statistics, which are much more boring, a little bit harder to find, but those are the traits you really want to find.
Okay, I like it. Making sense to me. Curious, a couple of years ago, did you slow down your acquisition due to the hyper appreciation of multifamily, low interest rates, 100% bonus depreciation, or what was your appetite? 36 months ago. How many deals were you saying no to generally, or were you still able to find decent deals that are still performing today?
Yeah, great question. If you look over the last 5 years, our investment thesis has evolved. In 2021, it was just like get in the way of rent growth, but avoid areas that are going to be supply challenged and get as much long-term fixed rate debt at 2 and 3% as we can get our hands on. Because we felt like it was a pretty good asymmetric bet that rates were more likely to go up than down. Fast forward, we've been looking as market rent growths have come back down to earth. We've been looking more and more at assets where we can do something to invest in that property to drive organic cash flow growth. I think the most dangerous investment is one where you have no tools to drive cash flow other than hope that the market goes in your favor. Because if it goes against you, you have no tools. And so we've been continuing to look for those assets that maybe are a little bit older, but have opportunity to reinvest capital where those rents are maybe at $1,200 and the Class A deals are at $1,800. It's still in markets where people can afford the rent versus them being pinched on their income relative to rent ratio. And so that's where we've been deploying assets. So that's really what we find interesting today.
Okay, so thank you. That's helpful. Curious, did you slow down 36 months ago? Were you saying no to more deals? Have you had any struggling dogs that you bought and got caught with the floating rate debt and rent growth obviously stalling out? I'm just wondering on that, like what is it like for you guys in your portfolio?
Yeah. So when I started the company 25 years ago, I made a simple decision, which was these assets are going to outlast me. They're going to last 50, 60 years. So try to go long-term on the loans. So long-term debt. Secondly was at the time, Alan Greenspan would sit in front of Congress for hours and I'd have no idea what he said. He didn't know which way interest rates were going. So we just said, let's always do fixed rate loans. And so those two things have allowed us to focus on the fundamentals of real estate versus becoming speculators on interest rates. If you want to speculate on interest rates, bet on future contracts. If you want to become a real estate investor, take that off the table. And so we don't do floating rate debt. I think 98% of our loans are fixed rate. We're in the high threes on average. Maturities are, like 18 years in one of our funds. It's a really bulletproof debt strategy. What that has allowed us to do is focus on the one or two deals that have had some NOI challenges because they had a little bit more supply. But the vast majority of our portfolio is in those boring markets where developers didn't show up by the busload to build new units. So
Excellent.
We've been very fortunate.
That's great. Way to go. I think that speaks volumes. So it sounds like your average fixed rate debt is 18 plus years until it matures. Is that what you're saying there?
Yeah.
And is it fixed? Is it fixed for 18
Yep.
years?
Yep. So
okay. You get a lot of HUD stuff, or what are you guys doing?
Tons of HUD stuff. We are one of the largest HUD borrowers in the country.
Oh, okay, excellent.
HUD is a really arduous process, but if you have 40 years to go through therapy for getting through that process, and your interest rate is 3%, you'll be okay. You'll be okay.
Yeah. No, you're right. You're spot on, and that's great. And then you can weather the storms. I think it was just wild. You know what I mean? And we sensed it, and we got out as best we could, right? And I just think the 2008 crash taught us a lot. And then this shift here, I feel like hopefully taught us a lot. And you're right. If you've over leveraged and you have, betting on just rent growth continuing, and you're not fixed on the interest rates, the ship gets sunk. I feel like the jiu-jitsu tap out of multifamily is either happened in 2025 or it's happening right now. I feel like it's more like right now. But I'm curious where they finally like, all right, we're going to let Dwight buy the property for what it's worth, right? Or we're going to give it to the bank, right? So now let's fast forward to today, right? Do you feel like now is the time, and 2025 is the time? You're probably always buying, of course, right? But I mean, what is your sense of, are we close to or at the bottom for multifamily opportunities?
Yeah, I think we are not at the bottom. I think we're somewhere on either side of it. When you look at really, there's a ton of capital raised for distress. And I would say there's been discomfort. There hasn't been real distress for a couple of reasons. One, sponsors exist on a continuum where how quickly they incorporate the market knowledge. So somebody who's a mom and pop developer, he's going to remember that he got an offer for $300,000 a unit in late 2020. And today the brokers are telling him it's worth $225, and he's, no, it's worth $300 a unit. Versus an institutional investor, they incorporate market feedback very quickly, and they've marked to market their portfolio. And so you've had this migration of people moving down that realization curve of saying, you know what, I missed the boat in 2020, 21. It's not coming back for me. So that's issue one. Most people are now recognizing that the market is never going back to a 3 cap, or at least not for another couple generations. Secondly, you've had of the folks who are on short-term floating rate loans, they had built-in extensions in those loans that they executed, and now they're kind of at the end of their rope. And so the combination of those two things, I would expect more market capitulation on some of these assets that have been mispriced, and they are, in terms of what the current owner thinks they're worth, they're going to get rationalized through a sale or recapitalization at something closer to market value. And I think that is a great opportunity because you're going to be able to buy those assets way below what it costs the last guy to build or buy, and at rents and NOIs that are at cyclical lows. And so if you have no more supply coming in, like, this seems like a really good time to put some chips behind NOI and market growth.
I couldn't agree more. Dwight Dunton, everybody. And you can find more about his company. He's the CEO and founder of Bonneview Venture by going to BonneviewVenture.com.
Bonaventure.com.
Sorry. This is a lot going on. BonneVenture.com. BonneVenture.com.
Yep.
Good. Okay. Well, this is going well, and I'm liking this conversation, and it's helpful. And I agree with you. I think now is a great, even in the last 12 months has been a really good time based upon market fundamentals and basis, right? And being able to it may always make the numbers make sense. Focusing back on the mom and pops, right?
Yep.
Who didn't sell for $300,000 a door. My premise is this, Dwight, that most of these mom and pops who've owned for 27 and a half years, fully depreciated, and they've got 300, 400 units, maybe 2 properties. The number one reason they're not selling is because they don't have a great capital gains tax exit solution, right? And most of them feel like they're going to either have to overpay in a short period of time, or have to take on debt or equal or greater value or more debt, depending if they have no debt on the property or not. And the 1031 can be pretty frustrating. I'm curious, what have you found to be the biggest frustration when it comes to the 1031 exchange as it pertains to the mom and pop, owner who maybe owns 3 to 5 properties and maybe is trading, 3 to 5 times in their entire life?
Yeah, I think you nailed it. The status quo becomes our biggest competitor to getting a deal done because the current owner says, you know what, I'm more comfortable here than I am doing a transaction. And taxes really are the tail that wags the dog for someone that's owned a property for a long period of time and has depreciated it. And so we've done about $1.3 billion of exchanges for our portfolio and our clients over the last 25 years. And we have used every tool in the IRS toolbook to help defer giving our LP, Uncle Sam, his share. And that's the amazing thing about real estate is there are so many tools, but unless you're using them every day, it becomes really hard to access them. And so the 1031 exchange is an example of that, where with the 45-day identification window and the 180-day closing window, for a casual investor who, to your point, might do 2 or 3 of these in a career, it's daunting. Where we've created an entire solutions framework is we do this all the time. We have deals in the market where we're buying and selling for our account or for clients, and we can tee up that solution in advance for them so that they don't have to worry about what property they're going to buy. We might have it in our portfolio. So we work with a lot of clients before they've ever sold a property. But the other cool thing is there's what's called a 721 exchange, or commonly called an UPREIT, where if that investor owns a great apartment building or senior housing home fund or senior housing building that would be a great addition to our fund, they can contribute it directly in. And they don't have to worry about the 1031 exchange. They don't recognize the gain today. And they go from owning one good building to now becoming an investor in a diversified portfolio that is institutional quality, institutionally managed, and that can solve a lot of families' problems, especially when you've had somebody who's been hands-on and they're at the point in their life where they're like, I don't choose to do this, or worse, I can't, but I need to have someone to take care of that. Bonaventure or other companies can become that successor to running that property, but also they don't have to worry about the tax challenges of doing an exchange on their own or going into a triple net property, which again is one of those properties that might look good on paper, but there's no tools to drive NOI growth. And if you happen to have been unlucky and bought one of those triple net properties that's now to a bankrupt retailer, you're in deep trouble. And so I think that both the 1031 exchange solutions that we can offer folks, as well as the 721 UPREIT solution, is a really powerful set of tools, and you can combine those. So imagine now you're starting with an office building that you're like, or retail that you want to sell, and you'd really like to get into a fund. You can 1031 exchange into a replacement property that then gets folded into the fund. So that's a common tool that is becoming more common every day. Lots of sponsors are offering that solution for families.
So let's dive into the 721 a little deeper, right? Does it provide liquidity and diversification? Talk about if someone trades a $10 million apartment complex into the 721 UPREIT, how quickly can they receive or get access to that, any of that capital?
Yeah, so great question. First, the answers I'm going to give may differ by sponsor to a degree, but I'll try to give some high-level answers. One, diversification. Absolutely. You're going to go from owning one property to now becoming an investor in a portfolio of assets. So you get diversification straight off the bat. And then in terms of liquidity, most of these programs do have limited liquidity, either after a hold period. For instance, in our fund, it's a 1-year hold period, and then you can start participating in a quarterly redemption process. But most sponsors, in order to have a business that meets the needs of the investors, they have to provide some measure of liquidity. And that's either monthly, quarterly, or annually.
Okay. And then what percentage of that can typically be, and maybe just help you guys, right?
Yeah.
So for you guys, they put 10 million in and they wait for a year and they get, let's say 6% cash on cash on that first year, some cash flow. But then in year 2, what amount, if any, can they get of that 10 million?
Yeah, great question. Usually it's subject to a overall fund limit. So for instance, our fund is subject to 5% of the fund's NAV per quarter. So right now that's just shy of $30 million across all investors. So in your example, if our fictitious 721 exchanger had a $10 million property and got $10 million of units, they could tender all of those. And as long as the rest of the folks that tendered during that quarter were less than the cap, they would get repurchased in their entirety. Alternatively, if more than the cap tenders, then people get purchased proportionately. So it really differs on sponsor. You should really look at their investor mix to see whether they have, quote, hot money, because a lot of funds had hot money that got in 2020, and then everybody rushed for the gate in 2022, and they hit their caps and gated them. Other sponsors like ours, we have a lot of tax advantaged capital in our fund, and so those folks are much more long term, and so we've always been well under our caps on a quarterly basis.
Okay, keeping going here. You mentioned you get to purchase in the diversification. In one sense, you're still in the same asset class, which not necessarily. I'm a real estate guy, so I love real estate. So, and you go in, let's say, from office to maybe all multifamily. I'm not sure if these 721 REITs have industrial, mobile home park. Maybe they're all just typically one asset class, but it is multiple properties, which I get that piece of it. You mentioned you get a percentage of all of the other properties. I guess it's a NAV REIT, right? So it's the share at that price, at that point, right?
Yep.
So you're buying into it at that given time period. Is that how that works for how you're buying when you're coming in? Is it based upon that year's valuation?
Yeah, so I think it's a negotiable based on your contract, because each one of these transactions is bespoke. It's not like a pack of gum where it's always the same. So it's totally bespoke. But in our situation where the client has a $10 million property, and if the NAV of the REIT was $10 a share, they would get issued 1 million shares at closing. They hold them for a year, they collect their cash flow, and if those are at $10.10, or they could be at $9.90 a year later. That's the value of their stake going forward. So I think one of the questions I get a lot is, what if the share price goes down? And I think most investors already own that risk, because if NOIs are falling, it's likely the property they own would be subject to the same force. And so if you're trading one asset that's similar to the assets in the portfolio, the business risks are similar, but you get diversification and you get limited liquidity. So I think in those situations, that investor would be better off, because his property NOI could go down as well, even if he didn't transact.
Okay, so back to your scenario. I know there's like gates and caps and all this stuff, but in general, if someone had $10 million with Bonnevie Ventures and they're there for a year and they wanted $1 million out, is that too much of a general number? And or 2 million or 3 million or 4 million or 5 million? Like, is there ever a general rule of thumb that X amount of percentage you could expect in a given year?
We've never. All I can say is our cap is 5% of NAV on a quarterly basis, and we've never come close to hitting it. And we're in our 2021, so we're in our 5th year of existence with that fund.
Okay, keep going on tax advantages. So the basis does travel like a 1031, right? So if I'm fully depreciated on a $10 million asset and I go into a 721, my old basis travels, correct? And if so, the cash flow that I'm receiving, I know, of course, I'd probably now purchase, because it's leveraged. I don't know what kind of leverage you're putting on that, but so there's probably some more basis in that. So walk me through, maybe just generally speaking. I know it's going to be particular every single taxpayer, but how much on average am I going to maybe be paying in tax if I don't have any basis?
Yeah, great question. So if you were an investor in our fund and you paid cash, over the last 4 years, I think like 98% of our distributions have been tax sheltered. So it's been a really high proportion. Alternatively, if you're an investor that trades their property in via 721, they're going to have a carryover of their previous depreciation schedule. And so that's really going to answer that question. But as the fund adds more properties, there can be additions to that investor's basis. So, I think that is on an individual basis, but your comment is it's generally you're rolling forward your depreciation schedule you had on the previous asset.
Okay, cool. This is great. Okay, I like it. And you guys are also doing, I guess, just syndications where you're just carving out doing a tick venture, versus 721. Is what do you do more of? Yeah.
So, our business is, the economics behind it are housing's broken and there's always a way to make money, but the wrapper differs by investor. So sometimes it's a DST, sometimes it's a syndicated investment where people say, I want to invest in that property with traditional cash. Other times it's like, I love the diversification of a fund. Other times it's like a fund that's dedicated to a specific business plan like senior housing or value add. And so we provide different tool handles to make it user friendly for those investors, because we understand one size does not fit all.
Excellent. By the way, you mentioning DST, it's one of the things we focus on too, but we use the other one typically. Although we sometimes use the Delaware for like debt over basis issues with like zero coupons to replace the debt over basis, and then going into a regular 1031 or going into a deferred sales trust like ours.
I was using the Delaware statutory trust, and you were referring to the deferred sales trust.
This will be good, right? Because I grew up in Taxifornia, and then building houses with my parents, rentals my whole life, and then I went to Marcus and Millichap, Dwight, right? And during that time, this is 2006, things were pretty red hot and going pretty well, and lots of people 1031ing and high fives, you know, when you were the seller, but all of a sudden now you're the buyer, you're kind of pulling your hair out and you're running around. And so we saw the market crash. For those who got hit the hardest were those that overpaid in a short period of time and took on too much debt. In fact, most of the crash was single family debt related. It was not multifamily, and it was not commercial. We're seeing more commercial distress this time than single family for all the different reasons. But my point is the 1031 is not always your friend. And we found that even for the multifamily groups we work with, like you guys, the challenge is also that it only works for investment real estate.
Yeah.
But guess what? If you're selling a business, Bitcoin, stock, primary home, you know, the 50% of all wealth in America is tied to high-end primary homes, commercial real estate, and then private equity, which is businesses. And so, for example, we just did a $70 million exit up in the Northeast for a big tech sale. Well, the great part about that with the deferred sales trust is we can defer it all. It can go into funds like yours, Dwight. It can also go into stocks, bonds, mutual funds, more, truly liquid investments. I'd say diversified against different asset classes. Now, I'm not a huge stock guy, but there's balance in all the portfolios, right? But you can also go back and do your own deals, okay?
Yeah.
And not be stuck. Not that someone wouldn't want to put all their 10 million with Dwight on their deal, right? Or 20 or 50, 100 million, whatever it is. But they might want to diversify into tranches, into different deals at different times. And so I call it the Swiss Army knife to the old Blockbuster 1031. Not to say that 1031 Blockbuster is not still a good place to go to get that movie and return it in 3 days, right? But the ability to truly have diversification with asset classes, but also with timing. We did a couple of years ago, Dwight, we exited like a $13 million asset in San Diego for a client. We sat in real estate debt for the last 2.5 years. Right? Now, we bought strategically some hotels that were distressed in the beginning when we first did this, bought some Bitcoin with it at 40,000 a coin. That is at least doubled at this point. Bought into some stocks, but mostly it's been heavy real estate debt, just making double-digit returns, above 10%, and it's doing well. So I'm curious, A, have you heard of the Deferred Sales Trust, number one, and B, what are your thoughts on it versus the Delaware after I just shared all that?
Yeah, no, I am a student of all tools that the IRS allows for not giving Uncle Sam more than his minimum share. And so I think the Deferred Sales Trust is absolutely a really interesting tool, especially when you have a concentrated position and you want to roll that into something else and get the diversification that you mentioned. I think it's a fantastic tool. I've never done one, but I've looked at it extensively, and I kind of, have to know a little bit about everything in my role, because really we're trusted advisors, and I want to be able to tell somebody like, here's what I think the right solution is for you, and you should call Brett because he has that solution in hand. And so I think it's a fantastic tool for folks who want to continue to stay invested, but they want to trigger a gain on a large asset.
Excellent. Thanks for sharing that. Yeah, people want to learn more, go to capitalgainstaxsolutions.com. A couple other things to think about. Most people think when they think deferral, they're just thinking of the gain, the state, the federal, Obamacare. It's called, I like to say 20 to 50% depreciation recapture, depending on what state you're in, okay? But they don't necessarily look at the ongoing deferral of income tax. Okay, income tax is the highest tax. I think the highest tax we'll overpay, right? So what's really unique about the deferred sales trust, Dwight, which I think you'll appreciate, is once the fund's in, let's take that same $10 million exit, okay? And let's imagine you had a zero basis and it was in New York, and you had paid $4 million or whatever on that 10. You had no debt, so it's really simple. So you can go the 721 UPREIT, or you could go into a deferred sales trust. Now, on the 721, let's just say you guys are averaging 6 to 7% payout per year, right? That's $600,000 or $700,000 of cash flow, right? Give or take. Well, in that scenario, they'll have some depreciation offset, but they'll still be probably limited because their basis traveled. But the point is they have to take it. Okay, so they have to pay the tax. On the deferred sales trust side, I would say another scenario, right? That same 10 million, by the way, can go into a deferred sales trust. And that same 10 million can actually go into your real estate fund. We would do it probably through a joint venture partnership with a new basis. And we'll kind of talk about that a little bit later. But the point is those funds can roll like an IRA. What does that mean? Well, that means that they don't have to take the income. That means therefore, in the year they don't take the income, they have zero income tax. Some of these ultra high net worth clients we work with, they don't need or want that extra $600,000 or $700,000 in year one or year two. And we can delay it at least for 2 years. And this has the compounding effect of income tax deferral, which is huge, okay? Second piece of that is even when they start taking some of the income, they don't have to take the full interest payment because we're changing the nature of investment real estate, continuity strategy, 1031, 721, to a 453 installment sale method, which is you're becoming a lender, and the lenders have different rules, okay? And at the trust level, the trust typically, even though it earns that 6 or 7% net of fees, it's able to expense it even if it hasn't paid it out. And this allows this really elegant, kind of like a big IRA, where the client and the note holder in this scenario only pays tax if and when they receive a distribution. And so there's this compounding effect where you're deferring income tax at a scale. And when you map this out on an Excel spreadsheet side by side, it's staggering. And the next thing I'll leave with you here too is estate tax elimination. People cannot forget that you can either have a stepped up basis or you could have it outside your taxable estate. But you can't have both, okay? And so another scenario, let's say you're a $130 million apartment complex in Virginia or New York or, California. And let's say it's free and clear and you have it all inside your taxable estate and you're a married couple. Well, you get 30 million exempt for the new amounts, right? 15 million single. But if you don't sell it and you just say, I'm going to wait for the stepped up basis, or I'm just going to do a 721, or I'm just going to do a 1031. Well, you're doing good for cap gains tax. You get a stepped up basis, but not for estate tax. The government's going to require 40% on 100 minus 30. Or 130 minus 30, which is 100, times 40%. That's a 40% debt tax. So this is next level. That's the elephant in the room. The tiger by the tail is the cap gains, right? But the big elephant is really to gobble it up. So with our strategy, we can eliminate, we have a 2.0 strategy, all of the estate tax without any charity, life insurance, or gifting required. And that's a powerful thing because most people run out of kids to give to. Life insurance is very expensive, and it just puts a Band-Aid on what you have to pay post-death. And not everyone wants to give it all the way to charity all at once, right? And so anyways, I'll just throw that out to you as well. I'm wondering if you have any creative death tax strategies that you want to share with us.
Well, I'm not an attorney, and I'm not a CPA, but I have stayed at the Holiday Inn Express for the last 25 years. And so everything I share is something I've gone through. And so we had a situation, my dad passed away 4 years ago, and we had used lots of irrevocable trusts to reduce his estate value. But to your point, a lot of those real estate assets with very low basis ended up in trusts and did not get the advantage of a step up. And so this is a very real thing you're talking about, which is how do you balance capital gains and estate taxes? And so if I had it to do over again, I would take a totally different approach to what assets would be inside the trust and what assets would go through the estate. And I would have still moved assets into the trust, but then I would have exchanged them back out to my dad personally so that the low basis assets got the step up. And so I think in your DST, your deferred sales trust, I can understand immediately how the basis of the taxpayer would be in the note that they hold that goes through their estate. That gets a step up. The basis of the assets within the trust got market value when they were contributed. And so like, it's a beautiful thing. I see exactly where you're coming from as you say that.
So to be really clear, there's a 1.0 and 2.0. On the 1.0 version, there's not, you can't step up a promissory note. That's the 453 installment sale reporting, but the kids can step into your shoes. So you're still inside the taxable estate. On the 2.0, we actually use our irrevocable trust. Okay. It's different than 453. It's another one. But again, no life insurance, no charity, no gifting required. Now mom would have to be alive. Dad or mom would have to be alive, and sell the asset to a third party buyer in exchange for, it's kind of like an annuity contract. But the cool thing is the funds can be invested into whatever you want. It can go back into your own fund or your own deals. Like it doesn't have to stay within like an annuity or insurance. Like it's totally flexible for how and where the funds can be invested.
That's exciting.
Yeah, it's really cool. So people want to learn more, go to capitalgainstaxsolutions.com. We also wrote a book on it called Building a Capital Gains Tax Exit Plan. You can find that on Amazon. We got Kevin Harrington from Shark Tank and some other cool things. Dwight, thank you for geeking out with me about that. It's really passionate about that. Let's move to the lightning round. You ready?
Yes.
All right, knowing what you know now, if you go back to your 20-year-old self, what's the one gold nugget makes you tell yourself to do?
I would focus more on the teams rather than the Excel. Like everybody's rich in Excel, but no Excel business plan survives first contact with reality. And so making sure I focused more on the teams that had to execute rather than the Excel on designing the deal.
Okay, excellent. Question number 2, number 1 book you've recommended the most in the past year?
Number 1 book I've recommended most in the past year. I would say it is. I just picked it up. It's the billionaire sequel from the guy that started the rental equipment. It escapes me. I'll pull it up and I'll send it to you.
Okay, sounds good. Next question. What are you most curious about right now?
I'm spending a ton of time on vibe coding. It is transformative in terms of being able to create tools and applications as a layperson without needing to be a programmer. It's unbelievably powerful. It's going to transform everything. I'm not one of these AI high priests, but it is going to transform everything.
You call it live coding?
Vibe coding.
Oh, vibe coding. Okay.
Yeah.
Is there a particular AI technology you're using for this?
Yeah. So there's several, a product called Replit. It's a website. You can just start in a chat window, say, build me an application that does this. A little more advanced is a tool called Cursor, which exists install it on your desktop. But long story short, I've been able to create some really powerful applications not knowing any programming. And we are now rolling it out to our entire company to put the power in the hands of our team members who know the business problems. They're just not coders. And in moments, they're able to create tools that were solving problems that would previously have taken them weeks.
Okay, fantastic. I'm going to check it out right away. Next question. How do you best stay ultra healthy and super disciplined?
Super simple. I focus on having a plan to work out 7 days a week. So when the world happens, I get 5 in.
I love that, right? That's good. The same here. And I think I'm averaging 6. And now I do jiu-jitsu, basketball, lifting weights. I mostly lift weights at least 5. And then usually I'm filling in with some double days with jiu-jitsu or basketball. I'm 42 now though. My calves and my hamstrings are really are you sure you can do 5, 6, 7 days a week? And I'm like, well, maybe.
You got to get some yoga in there, man.
That's true. I do need to get that. They're opening up a Lifetime here shortly, and I'll be able to just join them on that. Okay, we'll wrap it up here with the really the last question, and this will kind of bring all this to a closure. By the way, this has been amazing, Dwight. I want to just thank you for sharing your wisdom, your insight with us, and your deep understanding of multifamily investing and helping people with also tax challenges when they exit these assets. So, how do you best keep a mindset of stewardship over ownership, and really, keep at the center serving the families that you serve?
Yeah. Everyone here at Bonaventure is on a mission, which is to serve our clients, to help them afford those long-term dreams. And when I get a phone call or an email from one of our investors saying, thank you, I was just able to accomplish this life goal because part of that solution was Bonaventure and the investments I had, that keeps me going. That's the gas that fills up my tank.
Amazing. Dwight Dunton, it's been more than a pleasure. Thank you for being on the show. Everyone, you can find Dwight by going to bonaventure.com, and check it out. Check out the track record, check out what they're doing. I also want to thank everyone for listening or watching this episode of the Build to Billions podcast. We're also streaming on Capital Gains Tax Solutions podcast and YouTube channels as well. And we're on this journey with you to scale it from millions to billions so we can give more all of it away to help MVPs, the most vulnerable people. I want to encourage you to take action today, especially if you have a large exit of over $1 million of Bitcoin, business, or real estate, and you're looking for flexible ways to eliminate the need for the 1031 exchange and be able to invest on your own timing. Go to capitalgainstaxsolutions.com. It's capitalgainstaxsolutions.com. Appreciate everyone listening, watching, and we'll talk to you again real soon. Bye now.
You have just listened to another information-packed episode of Capital Gains Tax Solutions with Brett Swarts. We hope you enjoyed today's show and found it helpful. Visit capitalgainstaxsolutions.com to access the show notes and to access more resources. Don't forget to leave a review and join us again next time.